Hello and welcome to Policy Watch, your packed snapshot of the week's biggest business stories, their context, their relevance and impact. I'm Govindraj, Ethiraj. A much anticipated Fed rate hike did not happen on Thursday after the Fed bowed to sentiment in emerging markets and a fragile global macroeconomy. The move has been greeted warmly by Indian markets as they've moved up. Let's understand the impact a little more before we analyze it.
Indian markets had watched with bated breath, knowing a rate hike by the US Fed would spell mayhem for them. A massive moving out of FII funds. Announcement of a status quo in the United States said things could look up again.
The Federal Open Market Committee reaffirmed the current 0 to 0.25% target range for the federal funds rate. Since the committee met in July, the pace of job gains has been solid. The unemployment rate has declined, and overall labor market conditions have continued to improve.
For emerging markets like India, the US Fed's decision came as a boon. The Sensex and Nifty gained strongly on Friday. The rupee also rallied to its strongest in 3 weeks, lifting the market sentiment. The central bank is set for its bi-monthly monetary policy at the end of the month under immense pressure from the government and industry to cut interest rates to boost growth. The RBI chief says the key to economic growth is a low inflation.
The key tasks are to keep inflation low, not just today, but well into the future, so that we get moderate nominal interest rates.
RBI's rate cut hopes brighten after retail inflation eased marginally last month, continuing the deflationary trend seen in the last 10 months. Wholesale inflation had also plunged to a historic low in August. Bureau report for Rajya Sabha Television.
Well, joining me now to understand the impact of the Fed rate not hike, I'm joined by Chokkalingam, founder of Equinomics, and Arindam, Banerjee, analyst at Kotak Securities. Gentlemen, thank you very much for joining us. Chokka, let me begin with you. So you were one of those who said that the rate hike will not happen, alongside a few others, mostly bond players in the US, as I understand. So why did you feel that then, and what do you say or feel is the impact now?
Certainly, because the fear is on the global economic front. There is a deflationary fear in many economies. You have Russian economy contracting, followed by Japan, South Africa, Brazil. So this is the first time that we are seeing so many economies contracting. And on the other hand, if you look at the commodity prices, oil prices are 6-year low. Many metal prices are 6-year low. Even the agri crop prices are 7-year low according to United Nations. So the deflationary fear is very reasonable, and also markets have crashed, currencies have crashed. So therefore, it is quite understandable.
But there's one factor which is on the other hand, which is that the US economy itself is looking strong. And getting stronger.
Yeah. Earlier also, before this meeting, the Fed officials said that they have to look at the other economies. The impact of any possible rate hike should be seen in the context of other economics conditions. So therefore, it has come at a right time for India, because now next hike, if at all happens, it could be in December or in March. In my view, the 3 months to 6 months time frame is enough for India to improve on industrial economic front and attract more FII money, which in any case was not coming in this calendar year. So therefore, I believe that
because of the likely rate cut.
Likely rate cut, and also to be very fair, the valuation was not comfortable. At 30,000 Sensex, not many foreigners found it very comforting to invest.
Right. So Anindya, can I come to you quickly? So what's your sense? I mean, is this the impact of the rate hike not happening? Is it going to be felt across the emerging markets as it's intended to be?
Yes, it is. In fact, in the yesterday's outcome, the outcome was almost in line. But the message which Fed gave through its mini statement and then the press conference is that they are in a state of confusion, because in the entire thing they talked about the negative interest rates. They talked about the possibility of a Fed descent, about hiking rates, and then about the world economic slowdown and the domestic economic strength. So it was a very garbled message which went out.
Yeah.
And we have seen the reaction on the European
But do you
indices.
feel that they are paying more heed to global factors, or as in this case macroeconomic fragility?
Fed in the history, if you look at, they have always paid heed to the global factors. So last time when Fed became
so there's no change in consistency.
No,
in that,
it was in the 97 and the 98 era when the Asian financial crisis hit. They had to cut rates in US, though the
Right.
US economy was doing fantastically well. So Fed is...
that part is consistent.
Yes.
So let's understand now, Chokka, let me begin with you. So what is the impact as for us? I mean, you know, and let me contextualize that. We were in a sense being held hostage to a variety of international factors. One of them was a potential rate hike, but there were other factors which could have affected us, China being one, the failure of, I mean, not the failure, but let's say the fact that Brazil has gone into a junk bond status, and there were so many other factors. So are we sort of getting freed up from some of these factors now?
In my view, actually, more than the global factors, the domestic factors are impacting.
Okay.
For the last 2 years, industrial economy is not growing enough, and the rate cut is not happening. We are the only few economies in the world to still have a tight monetary policy. And as I have been saying, you know, nearly 20 countries have inflation close to zero. In nearly 20 countries, you have interest rate close to zero. So we are the only one, you know, talking about high inflation despite WPI in negative territory and CPI inflation less than 4%. So going forward, what it means is that definitely, you know, there is a case for rate cut, because now even the leader of the world is worried about deflation and not hiking the rate. So you have to cut the rate. So which is going to do a lot of positive thinking for the market as well as for the industrial economy.
Okay, but that's not what you're saying.
No.
Okay.
Actually, see, the issue on the ground is lack of demand, and that is an issue in the world and in India itself.
Yeah. And which is why our exports are falling as well.
Absolutely,
which we'll talk about later. Yeah.
And we have a huge linkage with this entire hard asset deflation, which is playing out. Just not through exports. If you look at our rural economy, they are dependent on the real estate for wealth, and they are dependent on the agriculture for income, and both of the sectors are in a downturn. Then we look at the metals and the mining sector. There is complete linkage with the hard asset boom. Then the exporters, as we talked about, and so when you look at all these in totality, it is not a surprise that the demand in the economy has gone missing. India would benefit from a commodity correction. India never benefits from a commodity crash. Historically, if we look at whenever a commodity has crashed, as an example crude, Indian economy has done quite poorly.
Okay, got it. So, Chokka, markets were up on Friday, closing. Sensex closed over 255 points up. I mean, this is not a major turnaround, but it's definitely shows that the markets welcome the Fed not hiking rates. So, what's the prognosis like?
I have a firm view that the worst is over. In next 2 to 3 months, a bull run will start. Yes,
on the basis of?
Yeah. There is a problem on export, which is not in our hand, it is exogenous because of the global factor.
Right. And China is slowing down as well.
And second problem is the poor credit growth, which is growing in single digit. But on positive side, your indirect tax collections, even after netting out the exceptional item, growing at 12%. IIP has improved. FDI inflows are robust at 30%. Your forex reserves has though fallen last.
But do tax collections reflect a collection of taxes which were not being collected earlier, or a growing or a expanding
excise
economy?
duty collection has grown more than 30%.
Okay.
Which is an indicator of improvement in the manufacturing sales. So therefore, I take it as a positive one. And then you look at the FDI inflows, which is growing at 30%. You look at forex reserves, though fallen in the last 2 weeks, it is still close to record level. And of course, margin expansion. If you see the March quarter results compared with the June quarter results, in June quarter, mid-sized companies have grown their operating profit on average for about 3,000 companies, 100% over March quarter. So there is a clear case for benefit out of this margin expansion, and also the commodity crash is helping our.
But you also said that there is a demand contraction, right? So where is the margin expansion coming from? Is it coming because of productivity or?
It is coming in terms of the operating profit gain, rather productivity gain, because of the lower expenses on raw material. Top line has not grown even for the mid-sized companies, but certainly your operating profit is growing much faster, and that is what happened in 2010.
Okay, so from a market's point of view, it's good news, you're saying.
Yeah.
But is that good news for the economy? I mean, I'm not saying it's bad news, but does this mean that things overall look better?
I think there has been over the years since 2008 a big disconnect between the real economy and the financial markets, because we have seen the central banks in the world over embark on a monetary policy at a scale which the world has never seen. So this disconnect is just not in India, all over the world. So at a time, so when we are looking at the financial markets, the margin expansion is definitely an optimistic case. But when I look at the real economy, demand is simply gone missing.
Right.
And at this point in time, except for the fact that government can spend on roads or railways, there is very little that the government can do to boost demand.
Unless but government can do something, at least in the domestic context.
Unless it wants to go what the UPA did,
right?
That is to give tax ops,
yeah.
But it can be inflationary.
Okay. Okay, so let's talk about liquidity, Chokka. What's your sense there? Are you seeing that changing, any shifts because of that, particularly foreign portfolio investors?
Certainly, if you look at last 20 years, it changed overnight. The fear factor plays much longer, but the turnaround comes very fast. That's what happened in 2008, index crash. Having said that, all of us know that the current account balance has improved, fiscal balance is improving. To be very fair, the government has spent in the first quarter 30% more on planned expenditures. Even the latest data from Railway says that their capex expenditure have gone up 100%. So there's a lot of improvement in the capex. So a lot of improvement in the hands of the people in terms of cost saving. So this is going to give boost to the industrial economy the way in 2010 it has given. And lastly, this will be helping the government also to go for some stimulus measures.
Okay, so let me come back to the portfolio flows for a moment. What's your sense? Global portfolio flows, we've been seeing a lot of withdrawals near record levels in August, fairly high levels in September. Is that something that could reverse?
Yes, I think it will continue. For the simple reason, if you see the world, if I just zoom out and see why the portfolio flows were happening, is that the world economy was in a much better shape, even say 12 months down the road. The commodity crash is not an isolated case. It's a symptom of something seriously wrong with the world economy. So that itself has been a major drag on the portfolio flows. Secondly, a lot of the flows were coming from the nations who are exporting commodities or producing the industrial commodities or the agri commodities. So from there, the flows have gone down. So I see incrementally, both on the demand as well as the supply side, flows in the world financial assets will be lower.
Okay, so Chokka, if flows are low or not high enough, then do you still feel that the markets could be heading for something strong?
Certainly. See, it is a problem of mindset. A lot of people are talking about FIs leaving. It's about 20,000 crore. It's about $3 billion.
Sure.
On $250 billion base, this is nothing. We are not used to see outflow because that is a bull case for India except 2008 meltdown. So,
but maybe because the impact is large, even if, proportionately maybe for,
You are absolutely right. This country doesn't have appetite. The foreigners take a lot of risk. Two risks they take on the currency, because whether you take last 5 years or 5 decades, the rupee always depreciated 5% per annum. That is what I was saying. Don't worry about Fed, because the rate hike will not be even 200 basis points, whereas here they take 5% currency risk every year. So there's a strong case. They'll come back because you have 4,000 stocks listed in India, and hundreds of stocks have created phenomenal wealth for the same FIs in the last 5 year or 10 year, whatever time frame you take. So therefore, I believe firmly that this correction is good. It has made our valuation quite attractive once again. And I believe that the FIs will come back in a big way.
Right. So one of my earlier questions I was asking is that how many factors are now really playing on this market, right? So we talked about both domestic and international. So if I were to start with you, Arindam, if you were to now sum it up, what were the key factors that will play if we can remove the potential rate hike or remove it from the picture? What else is left that will sort of potentially drive these markets globally as well as domestically?
See, globally, I would be looking at China more.
Both good and bad news,
Yes, sure. I'll be looking at China more as a source of good and bad news, because Chinese economy, they have been holding out about the further depreciation because of external factors. So from October onwards, once the IMF centenary meeting gets over in Lima, the question is then would China actually go and devalue further? That will be a negative. If they don't, it's a positive. Second, we are expecting China to announce much larger stimulus. Now, how that stimulus plays out, we have to see, because China adding more capacity is net negative, say, for the world economy. Now, third, what I believe actually watching is the fiscal policy of the developed markets, because that is the only source of demand which can come into the world economy. So when over the last 5-6 years, we have seen consistently America, say Europe and Japan, they have consistently cut down on their expenditure, which the government was making. I believe there is a room for these countries to go out and spend on infrastructure, on other areas. If they do that, that will be a single.
So you're saying China is bad news, potential loosening up in Western Europe and North America as a plus point. Chokka, what are you looking at? What are the 2 or 3 things that...
I look at 2 factors in China. See, many people have not understood the...
So everyone is looking at China. That's the interesting thing. I mean, including the Fed, of course.
Yeah.
The one reason why they didn't do what they...
But 2 things which are not widely discussed. One, today the Chinese GDP is more than $10 trillion. You can't grow at 7, 8, 10% consistently on this base. They used to grow at 10% when the GDP base was $3.5 trillion. So this mindset of the analyst has to change for this arithmetic constraint. And 2, it's still sitting on $3.4 trillion of forex reserves, and it's amazing. And that's why they are able to throw hundreds of billions to provide stimulus. So I believe that China will come out of this.
Right.
And the market also will stabilize. Despite so much, hue and cry on the crash, today, even now, China is the best performing market on year-on-year basis, which is giving more than 30% return. On India, the rate cut and the NPA cycle peaking out, and IIP stabilizing around 4.5% to 5%, these 3 developments would give tremendous push to the markets, and I believe these things will happen in 3 to 6 months time frame.
Okay. Last word, Anindya. I mean, if in the context of where we are in the emerging markets as a whole, do you see us being able to pull away in some sense?
We will be on a relative, on a relative basis, but on absolute basis, no.
Okay.
We can't, because inherently we have inherent economic weakness which are there, and which will get exposed as this the global slowdown intensifies, which is our outlook over the next 6 to 9 months.
And Chokka, last word, very quickly. So, do you see the Sensex going back to 30,000 quickly?
It will go beyond that by December.
No, first 30,000, then beyond.
Yeah, by December itself or January, it should cross.
Okay.
And by next year December, it should give you 30% upside from this level.
Okay, good. So that's a good optimistic note to end on. Thank you so much. We need to go in for a break. Coming up on the other side, the not so good news: exports have been sliding for the 9th consecutive month. Stay with us. Hello and welcome back to Policy Watch. Last month, the head of India's largest exporting organization said that he was expecting a turnaround in India's exports because the numbers for the first 10 days of August were looking good. Well, not only did that not happen, but exports have actually slid to a 9-month low, or 9 consecutive months of export slowdown. Now, exports are down 20% in August, down to 21 billion. It's been led by engineering and petroleum products, but the problem clearly seems to be larger, and it's not just confined to India. Here's a report.
A 20.1% slump in exports in August this year seems to have finally set alarm bells ringing. With this, they have fallen now for the 9th consecutive months, dragging down total exports by 16.2% in April, August 2015 and 16. As a percentage of GDP, exports have fallen from a high of 16.8% of the GDP in 2011-12 to 15.4% in 2014-15. The fall in goods exports has substantial repercussion not only on growth of the economy but also on the NDA government's much-wanted Make in India program. The bulk of fall in exports is driven by a few important commodities. During April to July 2015, exports of petroleum products declined 49.1%, agricultural products exports dropped 21.7%, and exports of basic metals fell 7.8%. Export of gems and jewellery, India's largest export segment, fell 3.3%. Positive export growth rates by the chemical goods sector was a comforting factor. Despite a sharp slowdown in overall exports, some key sectors have not lost traction. It's now for the government to help reverse the falling trend by improving ease of doing business and making Indian exports more competitive. Bureau Report for Rajya Sabha Television.
Well, joining me now is Amit Ruparelia, member of the All India Exporters Chamber and former chairman of the Textile Promotion Council. Also, Khalid M. Khan, regional chairman of the Western Region of the Federation of Indian Export Organizations. Gentlemen, thank you both for joining us. Mr. Khan, let me begin with you. We've, as we pointed out, 9 months of continuous decline. It's evident that India is not the only economy that's losing out in the exports game, but it's losing faster, seemingly, than many other economies. Why is that?
You're absolutely right, my dear. The exports from India is really on a turmoil. For last 8 months, the exports are falling down, and the last month, the August month figures shows about 20% decrease in the exports. The main reason which we feel, I mean, as a trade body, is there are 2-3 factors affecting the exports. First is the external factors, which everybody of us know. The softening of the prices of the oil, the commodity throughout the globe, which is a cause of very big concern to us. Contraction of global demand, that's the biggest issue, that the global demand is not there. The exporters are trying to do their bit, but unfortunately it's not helping. there is a war zone which is happening in Middle East, Syria, Yemen. They are all under war zone. Instability in countries like Libya, Egypt, Iraq is also a cause of concern. Plus, the African countries are having a political instability. All these are the external factors which are affecting the exports. Having said that, there are a lot of internal factors which is also affecting exports, which is a more major cause of concern than the external ones. That includes the high cost of credit which we are facing actually. The interest subvention which we are looking out for since the budget has been declared, but unfortunately it has not been in place. The other reason is the reduction and withdrawal of export benefits in the current policy. I mean, earlier the exporters were enjoying the FMS FPS to the rate of 8 to 10%. But unfortunately in the new scheme, the MEIS scheme, the incentives have gone to a level of 2% to 3%. And that also with the immediate effect. Had the government given us the chance to hold the old incentives for another 6 months, it would have made a lot of difference to us. The other thing which is again a cause of concern is increase in the steel prices, especially for the engineering exports. You must have seen the fall is about 30% in this month. The prices of steel has increased twice in last 4 months time, but unfortunately it has not been subvented by the drawback, which is very important. The input cost has gone up. Now the safeguard duties have come into play, which is about 20% which the government is levying, but they are not countering it with the duty drawback increase to the exporters. I mean, these are the few
just
points.
Hold your thought, Mr. Khan. Let me come back to you. Amit, you're in the cotton textiles industry. It's not been so bad for you, as I understand.
No, you see the Cotton Textile Export Promotion Council shows figures of -2%, but mainly the drop is due to the yarn exports, which China, has gone slow on. But we made up with home textiles and fabrics, which has covered up quite a bit of that. So, but overall, we are still showing a -2%.
Okay. So, what are the common factors between what you are facing and let's say some of the other industries are facing today on the export front?
Well, as far as
if any,
as far as we in cotton textiles industry is concerned, what we are facing is that the FTA free trade agreement pending with European Union, and with Pakistan and Bangladesh having zero duty. So we are suffering that 10% duty benefit which they are having.
Right, but my question is, is this linked to the overall contraction in global demand?
This is definitely linked to overall contraction in global demand. Overall, world trade has also shrunk by a couple of percentage. So that is also.
My question is therefore, are we getting more hit than some of the other countries for any reason?
Well, we are not. I would
or it depends on the industry.
It depends on industries. Some industries are getting more hit and some are not. Plus, our rupee, is quite volatile. Still overvalued.
Right. And that's an important point. So, Mr. Khan, let me come back to you. So, the rupee has, of course, depreciated, triggered by the yuan depreciation, and the markets have also been weak because of that. But isn't this a good situation for Indian exporters? I mean, we seem to have declined even faster at a time when the rupee also showed a depreciation.
The rupee depreciation is good, but it has to be stable. It can't be a volatile rupee depreciation. Labor-intensive units will benefit out of it, which has the local inputs in that. For example, the marine industry, probably the industries which are agricultural products industry, they will benefit with the rupee volatility. But unless and until it is stable, I don't think so it's going to help them. But all the other industries which are dependent on import inputs, like the gem and jewelry, like the engineering, they would not be benefiting out of it. The rupee has to be stable. That has to be taken care of.
So we obviously would benefit if the rupee was more stable. But let me come back to the other question on what lies ahead. Assuming things are like this, are we expecting, or do you think that we could continue to slide? I mean, what are the signals that we are seeing more importantly?
We got two programs of the Prime Minister Narendra Modi. One is Skill India and one is Make in India. Now, if we do Skill India, then we have the workers and we don't have the factories to employ those workers. And if we do make in India, then we got the factories, but we don't have the workers to skilled, you know. So we'll have to start in a balancing way. And the best way to start is to start with the small and medium manufacturers, because that's what runs this economy. Always a big company like a Birlas or Tatas or whoever they may be, they do going for modernization. They spend a lot of money on modernization, on R&D, and they reduce workforce. Whereas here in India,
improve productivity.
We have to improve product, but here in our case also we need the small and medium to give a push to the industry and to bring in more industries in their sectors, so employment can be generated.
Right. So, Mr. Khan, so if you were to look forward now, what needs to be done? I mean, I think what the points that Amit made to do with skills and to do with manufacturing are obviously, or make in India, are really long term in a sense, or medium to long term. Are there any immediate solutions, or do we have to really use this opportunity to pull up our socks, as it were?
I totally agree with Amit. I mean, what he said is totally right. But you know, the Indian export industry basically to our contribution of about 350 billion or 360 billion, which we are doing for last 3-4 years. That's also very unfortunate that we are hovering around that 300 billion figure for 3-4 years. It's the contribution there, 60% is from MSME. Until and unless you make the MSME work, I mean, in terms of giving them a facility of credit, in terms of upgrading them and giving a incentivized upgradation program, probably a tough program for textiles or for engineering, wherein the government subsidizes the interest rate, I don't think so we'll be going more forward from here. It's looking very grim, and unfortunately that we are not able to really, we will not be able to reach the export figures set by the government. I'm sure about that.
Let me put a question differently. Are there areas that India should be focusing on that are different? You know, I mean, maybe there are areas where we are losing our export competitive advantage, and maybe we should be shifting or churning our basket, so to speak.
Yeah, the baskets, of course, I do agree. Churning of baskets, if you talk about, yes, we are looking at Africa, but you know, Africa currently is going through a crisis because of the oil price reduction. The crisis is in terms of the currency devaluation, but they have the purchasing power, which we should look at. The currency devaluation is a factor which, until the oil stabilizes, probably that will be a difference. But Africa is the future which I feel that Indian exporters should look at. And in the current trend, I mean, what is happening now, US market is opening, okay? The European market, not all, but few are really doing their GDP is really phenomenal. Also UK, I feel these are the countries which we should focus on, but we need to market ourselves. So in order to market ourselves, we need to be funded properly in terms of market development funds, which is very much required. Why the government has to give us that impetus.
Amit, last word. So if you were to look forward, are you optimistic, pessimistic? How does it look for the next 9 months?
No, I think so. I'm quite optimistic that the Indian entrepreneurs will come and really try to do the best out of it.
They'll fight their way out of this.
They'll fight their way out of it. But yes, a bit of support, not a bit, a lot of support from the government is required at this stage to ensure that, you know, we once break that barrier of the 300 billion, because, you know, we've been moving at 290 and 310 billion of exports for the past 4 or 5 years. Though we've got a target of 2020, we keep on having targets. So we'll have to break that jinx, and everybody will have to come out, and the government included, to ensure that we get out of this.
Right. So concerted effort required, but all parties need to play their role, and that's hopefully will arrest the slide that we are seeing in exports. That's all we have time for on Policy Watch this week. We'll be back next week, same time. Thanks for watching.